Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities, the #1 annuity podcast on the planet. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states, including the beautiful one you're sitting in. Welcome to everyone listening to me on the podcast in podcast world, which is Stitcher, iTunes, Spotify, etc. And also the people that are watching this on my Fun with Annuities YouTube channel, which films these podcasts. You can watch the craziness and the crazy outfits for the people listening on in the podcast world. I'm wearing a bright red Stan the Annuity Man Adidas jacket, which is a little too bright, but that's kind of how I roll. I wear these logoed things. So today's topic's a good one. So let's just jump right in. Should you take your pension payment? Should you take the pension payment or the lump sum from the company? Which one do you take? So with 10,000 baby boomers reaching retirement age, I guess we all consider that 65, but 10,000 people every single day reach the age of 65, which means that you're either really close to retirement or you've retired or you're thinking about retiring. And I get a lot of calls, got a call last week, and I get one or two every week, at least one or two, which is I'm retiring, Stan the Annuity Man, America's annuity agent, and my company is offering they're offering two things to me. They're offering this lump sum, which is a big chunky amount, hundreds and hundreds of thousands typically, or they're saying, or we'll pay you a lifetime income stream. And the question is this: which one should I take? Should I take the pension that they're offering, or should I take the lump sum and then go invest it and then go or buy an annuity or a lifetime income stream outside of the company? Well, there's no good answers, just bad sales pitches, right? So I always ask them a couple things. Number one, what do you want the money to contractually do? And when do you want those contractual guarantees to start? I mean, I ask everybody that. I mean, the thousands and thousands and thousands of clients that I have, and I hope you become one, and we get on the phone and talk, that's what I'm going to ask you. Or you could just cut me off at the pass and just tell me the answers. What do you want the money to contractually do? And when do you want those contractual guarantees to start? So let's get back to the pension or the lump sum. If you come to me after those two questions and say, well, me and the wife, me and the spouse really want a lifetime income stream to start pretty soon after I retire, then it's a single premium immediate annuity structure. So the company is going to offer this monthly amount. Now, I would love to run that comparison quote. Spoiler alert on the comparison quote, though, about what we found, and I don't have a real stat on it, just me dealing with thousands and thousands of people. About 80 to 85% of the time, the income guarantee that your company is offering will be higher than when you give me the same parameters and I go quote every single immediate annuity carrier on the street. And you got to say, wait a minute. How's that even possible? How does my company beat all the big name life insurance annuity companies out there? It's because they want to keep the money. If you think logically about it, pension or lump sum, and you're the company, you're ABC Incorporated, and you've been working for ABC Incorporated for 30 years. ABC Incorporated, if given the opportunity, if given the choice, they'd rather pay you out a lifetime income stream than come up with that big chunky lump sum and give it to you. Now, it's your choice on what you get to do. It's not their choice, it's your choice. But what they're going to do is they're going to make that pension payment look very, very attractive when compared to the street, when compared to when those companies know that you're going to call Stan the Annuity Man, America's annuity agent, and say, Stan, give me the comparison quote. They know that they're going to probably beat it because they're probably calling me undercover and finding out what the quotes are, or going to my site at theannuityman.com and running the quotes themselves, which you can do as well, theannuityman.com. Run the quotes yourself to find out comparison quotes. But here's where you need to be real careful, though. A couple things. If you choose the guaranteed lifetime income payment from your company, then the claims paying ability of that company needs to be researched. And if you feel comfortable with that and they're offering the highest contractual guaranteed payout and you need income to start right now, go for it. You know what I always say, you buy an annuity for what it will do, not what it might do. And the will do is the contractual guarantees. And my mantra is, let's shop all carriers for the highest contractual guarantees possible, period. If Stan the Annuity Man representing all carriers cannot beat the company that you're leaving and their pension payment, then stay there if you feel comfortable with the claims paying ability of the company. But that's a big one, okay? Don't discount that. So, with all the mergers and things like that, you have to think about, does that company you work for, can they back up those claims for you, your projected life expectancy, or if it's set up joint life expectancies for your spouse or partner if you die and you want the income stream to continue, okay? The other thing that you need to kind of put in the back of your head is when they offer you the pension payment and you want to do an apples-to-apples quote, the best thing to do is to email me the guarantees that they're offering and let me run the comparison quotes to the structuring choices that they are offering. Most of the time, these companies don't offer the 30 to 40 different ways to structure a lifetime income stream payout. They might offer 5 of them, okay? And that's fine. We'll do a comparison quote to all 5. But what I would encourage you to do is set an appointment with me. Go to my site, theannuityman.com, and you can schedule a call. There's a button at the top, very prominent, schedule a call with Stan. And we can go through the different types of structuring. So the company you're leaving might not be offering the structuring choice that you want. They might only be offering life only and joint life only and life with 20 years certain and joint life with 20 years certain. Well, that's 4 choices out of 40. So that's fine. I'll explain those. And if those are perfect what you want and they still win, then you go with that contractual guarantee with that company if you feel like they can back up the claim. But a lot of cases we find is people say, well, they do win, but I want it to kind of do this. Remember the 2 questions. What do you want the money to contractually do? When do you want those contractual guarantees to start? A lot of people say, well, I want a joint lifetime income payment, but I want a lump sum cash refund to go to my beneficiaries if both of us die. That's a joint life with cash refund. Or you might say, I want a joint lifetime income, but I don't want my kids to get the lump sum because they'll buy Ferraris and Lamborghinis and come to my funeral like my kids will. My kids will just helicopter in, and then they'll get in the Lamborghini, and then they'll drive 2 miles to the funeral. But the point is, if you want to handcuff the beneficiaries, but yet make sure that 100% of the money is going to go to somebody in your family, not the evil annuity company, we can structure that. Or you might say, you know what, Stan the Annuity Man, I don't really want a lifetime income stream. I want a period certain. But they're only offered a 20-year period certain, and I want a 30-year period certain, or a 10-year, or 17, or 19, whatever. Then we can do that. My point is, the companies typically do, 80 to 85% of the time, beat the streets apples-to-apples quote comparison, but they're only offering a handful of those quotes and those quote structuring choices to you. So, I know that there's time they'll give you, like, well, you need to make a decision by blah. You need to tell us what you're going to do. Make sure you get me the information, apples to apples information. And obviously, we do not share any of that. I mean, it's confidential. All I'm trying to do is make sure you're making an informed decision on a decision that you only get to make one time. And because you only get to make it one time, you can't make a mistake, right? Nod your head, yes. So let's look under every annuity rock to make sure you're getting the highest contractual guarantee. Getting back to where you should take a pension or the lump sum. Going back to the 2 questions. What do you want the money to contractually do? And when do you want those contractual guarantees to start? If you say, we don't really need income, Stan, or I really don't need income, Stan, then you don't need to take the pension. You need to take the lump sum and you'd roll the lump sum into a rollover IRA, non-taxable event, and it goes, and then you can invest the money. And then you've got to go back to the 2 questions. What do you want the money to contractually do? And when do you want those contractual guarantees to start? And if your answer is, I want market growth, and I want opportunity, and I want real upside, and I want what the market's going to give me, then you do not need an annuity. Remember the acronym PILL that I came up with. P stands for principal protection, I stands for income for life, L stands for legacy, and the other L stands for long-term care, confinement care. Let me do it again. P for principal protection, I income for life, L, legacy, leaving money to your heirs, and the other L, long-term care / confinement care. If you do not need to contractually solve for one of those 4 items in the pill acronym, you do not need an annuity, regardless of what anyone tells you on late night television, bad, whatever they're running ads, or your local person that says you can get market upside with no downside. You can get market participation with no. Come on now. You have to be smarter than that. If it sounds too good to be true, it is every single time. Never, ever, 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 ever. How many times I say that? I don't know. A lot. Buy an annuity of any type for market growth. Hello? Index annuities are great CD products, fantastic CBD products. They were developed in 1995 to compete with CD returns. That's exactly what they do, and they're extremely good at delivering efficient delivery system for income riders, which are future income guarantees. So don't buy annuities for market growth. So if you want to take the money and just go invest it. I mean, that doesn't, just because you're getting a lump sum, and I know that annuity agents and advisors, all this money, what's called money in motion in the financial services business, money in motion. You have to do something. You have to either take the pension or move the money in motion. Agents and advisors want to obviously latch onto that money, right? That's how we get paid as advisors. But it doesn't mean that you need to buy an annuity. Annuities are there's very limiting choices. Now, I love the fact that when people say, well, I hate all annuities, Stan. This guy on TV said I hate all annuities. Listen, that's crazy. I mean, if you hate all annuities, you hate all restaurants. That's stupid. There's annuities that act like CDs. You already own an annuity. It's called Social Security. It's the best inflation annuity on the planet. You already own one. I know you might hate them, but you already own one. And annuities are the only product strategy on the planet that provide a lifetime income stream, period, end of story. That's the monopoly that they have. So do they have their place primarily as part of your income floor, in combination with Social Security and pensions like this, or an annuity? Yeah, that works. Or if you want to just protect the principal, great. You can buy a multi-year guarantee annuity or an index annuity for principal protection, CD-type returns. They do have their place, but it doesn't really mean that you need to own an annuity. I ruffled a lot of industry feathers on a previous podcast when I said, not everybody needs to own an annuity, but everybody kind of needs to have some market exposure. And the industry's like, oh, you can't say that, Dad. You can't say that. The annuity gods are like, you can't do that. But it's the truth. I mean, annuities are contracts. Not everybody needs a contractual guarantee. It really doesn't even come down to age, in my opinion. It comes down to, do you want to shoulder the risk, which means non-annuity products, or do you want to transfer the risk, which means annuity products? So, first of all, if you're at the stage of getting the offer of a pension or a lump sum, first of all, congratulations. I mean, you've made it to the finish line. That's fantastic. You should, go out to the really nice steakhouse and not for the bad chicken, not for the seminar, but just go and eat without the pitch, because you've made it. But it is important that with this one choice, not to just, oh, yeah, we're just going to do that. Oh, yeah, we're just going to go with this product. Oh, yeah, we're just going to roll the whole thing into a index annuity or a variable. No. Be very specific on what you want that money to do. And that can mean, hiring a fee-only advisor to manage the whole asset for you and everything. Getting a complete financial plan from some fee-only type planner like that. And maybe peppering in some annuity contractual guarantees, especially for when you're retiring. A lot of the times where annuities fit is in conjunction with the pension. Let's just say, got a call the other day, it's a great example. Guy calls me up and he was getting the offer for the lump sum. It was a big tech company, offer for the lump sum and also the pension. And I was familiar with this tech company. I said, the guy's name was Robert. I said, Robert, they're probably going to win the pension thing. And he goes, well, we need lifetime income. I said, well, they can back up the claim. So let me do a comparison quote, apples to apples. We discussed exactly how he wanted the structure to be and ran the apples to apples quote. The company, the tech company where he's retiring from, won, and they won in a big way. I said, well, you got to take the pension because, you own an annuity for the will do. Not what am I doing? The will do is contractual guarantee. So you have to shop all carriers. And in this case, the company as well for the highest contractual guarantee. So he took that. Fantastic. I was happy for him. I did my job from the standpoint of looking under all the annuity rocks to see if we could beat that quote. And we could not. and that happens a lot. But he came back and said, well, that covers that part, and then Social Security covers that part, but we still have an income gap for what I call the income floor, that money needs to come into the account every single month, regardless of the markets, regardless of who's in office, regardless of the Democrats or Republicans, regardless of anything. Okay, and that's the income floor. So what we did is, we took, all right, he's getting the pension payment and he's going to turn on Social Security at this age. What was the gap that needs to be filled? And we did a reverse engineered quote, meaning I think he said, well, we need an additional, $2,500 a month for the rest of both of our lives, him and his spouse, him and his wife. And what we did is we ran a reverse engineered quote, quoting all carriers to find the best carrier that would require the least amount of money to contractually guarantee the $2,500 per month for him and his wife. And we also structured it so that when the second spouse died, whatever's left in the account went to the beneficiaries in payment form until the money's exhausted, meaning that joint life with installment refund was the quote. And so it's going to pay for his life. When he died, the income stream continues uninterrupted and unchanged for her life. When she died, whatever's left in the account went in payment form to the beneficiaries listed on the policy until the money was all gone. And the evil annuity company didn't keep a penny of that money, even though they were on the hook to pay, regardless of how long either of them lived. If they lived to 150, they're on the hook to pay. That's the benefit proposition. That's the reason I said there's no ROI until you die, because your return on investment, we don't know that until you die. So in this case, it worked out where he took the pension from his company he's retiring from, and then we did a reverse engineer quote. Actually, and the income was starting later. So he wanted the income to start I think 5 years from when he was retiring, because he was going to turn on Social Security at the same time. So we ran an income rider and a deferred income annuity quote with income starting in 5 years, reverse engineering the quote for $2,500. And I believe income riders won for his specific situation. Sometimes they don't. Sometimes it's deferred income annuities. So, we quote everybody. I go into all quotes. And if you go to my site, it's not like we're only going to quote these. No, we're quoting everybody. And so you're going to get a national quote based on your specific situation for the companies that are approved in your state. Remember, fixed annuities are regulated at the state level. So each state approves certain products. So when you go in to run the quotes at my site, theannuityman.com, you're going to punch in your state of residence, and we are, our computer whizzes on my team, we're filtering those products so that it's just quoting the ones that are approved in your state. And when you go to like my multi-year guarantee annuity fixed rate annuity feed of the live sites, you put in your state and you put in the duration you're looking for, and you just see the ones in your state. Just remember that annuity quotes are like a gallon of milk. They expire every 7 to 10 days. You have to get them requoted or every 7 to 10 days, or you can lock them in during the application process. That doesn't mean you have to buy, but that's how you lock them in. But getting back to, should you take a pension or a lump sum? What a huge decision. First of all, congrats on having the decision. A lot of people aren't going to get that decision, but you've made it. You're watching this the podcast or listening to this podcast because you're trying to do your due diligence with it. All I'm going to tell you is be very specific on what you want the money to do, because if you're not, then someone's going to try to sell you a product. And you don't need a product, you need a solution. All right? So go back to those two questions. What do you want the money to contractually do, and when do you want those contractual guarantees to start? That's a good, and the PIL acronym as well, that's a good filtering system to find out if you want or need an annuity. And then if so, answering those questions will then point us to the product type of annuity that will provide the highest contractual guarantee. But if you say, you know what, we really don't need income, and we just want growth, then you don't need an annuity. You just need to go have someone invest the money for you and manage it, or you invest it as well. You could also do something what I call deferred SPIA, which means, once again, the annuity gods hate this one. They look down and like, Stan, the lightning bolt's going to strike you because you're killing sales. But it's something you need to put in the back of your head. Let's just say we got on the phone, you say, okay, I really don't need the income now. I really kind of need the growth. So we're going to take the lump sum, we're going to invest it, have someone invest it for them. But eventually we're going to need income. Okay. But you don't want to lock in that income for the future right now. You want a little bit more growth. You can always, at the time you need income in the future, you can always buy and have me quote all single premium immediate annuity carriers. I call that defer to SPIA. Now, annuity agents are going to want, probably a lot of them, not all of them, but a lot of them are going to want you to buy the annuity now and lock in the income guarantee for a future date. There's an argument for that. That's called an income rider or a deferred income annuity or a QLAC, whatever fits for you, and depending on your goals in the account, etc. But that doesn't mean you have to. I mean, there's an argument for you to not buy an annuity, take the lump sum, manage the money, and at the time you need income, then you buy an immediate annuity. Even better, at the time you need income, you reverse engineer the immediate annuity quote to solve for that specific amount of money that you need at that time. So that'd be a way to keep as much of your powder dry and not locked into an annuity, but solving for that income stream needed at the time you need the income stream. Because remember, with immediate annuities, income can start as soon as 30 days from when the policy was issued. Okay? That's just another, put it in the back of your head, but it's also another reason that I would encourage you to schedule a time to talk with me. It's a 30-minute block. Go to theannuityman.com, and at the top it'll say schedule a call. Click that. You'll see my schedule. You'll lock me in for that 30 minutes, and then we'll have this kind of conversation. I'll say, okay, tell me what you want to do. Answer the two questions. What's the goal of the asset? What's the quote that they're giving you? And I'll give you... Listen, I'm going to shoot it straight. I mean, I'm the top agent out here for a reason, America's Annuity Agent, because, as my grandfather said in North Carolina a long time ago, if you tell the truth, you don't have to remember anything. So, I love what I do. I'm passionate. Heck, the podcast called Fun with Annuities in the Will Do Studio, shooting it on the Annuity Fun Camp. I mean, can annuities be fun when looking at them the way we're looking at them? Yes, because it's a lifestyle play. You're transferring the risk to either lifetime income stream, okay, either with your company or with an annuity, a competitive annuity product out here on the street, or you keep your powder dry and then you buy an annuity at the time you need to transfer risk. You might, roll it into an IRA, have someone manage it for you, or you manage the money. You're not buying an annuity, and you might say, well, you know what? I kind of want to protect some principal. I might get a multi-year guarantee annuity or a fixed index annuity for principal protection because those are CD products. Once again, I need you to be very specific with the goals of the asset. Don't have someone pitch you the solution. You tell the person, hopefully me, what you're trying to solve for, and then contractually solve for it. Okay? So everyone's going to be coming at you. Everyone's going to be wanting you to come to a seminar or wanting to come to your place of work and give you the PowerPoint presentation and all of that stuff. Do your own research, go very slow. I know there's a time frame on when you need to pull the trigger, but take as much time as possible. There's never an urgency, ever, to buy an annuity. The urgency is to fully understand what you're buying, not what you've been pitching, the truth about the product. And with annuities, the great part is if you said, Stan, I really like that structure, but can you send me the specimen policy, like what the policy actually is, without my name, just all the verbiage? Absolutely. We can send you that. We can send you all, whatever you want to do your due diligence and to do it right. We will send you that. And I won't hound you or pester you or call you or whatever. The only way I'm going to call you is if you schedule a call. I'm never, ever going to pick up the phone and just dial you and say, hey, let's talk. No, we're not going to do that. I'm not going to do that. I hate when people do that to me. I don't do that. I mean, I just don't. But I'm happy that you're listening to this podcast because you're at the finish line. I mean, in life's race of 4 laps, you're at 3.5. I mean, you're getting ready to, I'm going to do the point for the people on the podcast. I'm putting my head through the tape of the finish line when you're running track. That's where you're at, which is exciting and great. And you should celebrate that and applaud yourself for getting there because that is fantastic. But don't take your eyes off the prize and don't get sold something right here. Don't get locked into something unless you want to get locked into a contractual guarantee. And the sharks are swimming. I mean, the blood's in the water, which is money in motion. The sharks are swimming. So you got to be real careful and filter things. You don't need a friend. I'm never going to be your friend. I'm going to be the best advisor you've ever had, period. I'm going to shoot it straight, be brutally factual, both if you need an annuity, if you don't need an annuity, I'm going to provide all the contractual guarantees possible and all the information possible. But just be careful out there. I mean, I'm glad you're at the finish line. Remember that your company is going to have a pretty competitive pension quote, that we need to do an apples to apples quote. But at the end of the day, include me as part of your due diligence, as part of the people that you are interviewing, to get the answers and get the information that you need to make an informed decision on your terms and on your time frame and at the scheduled time that you've been given to make that decision. And with that, I'm glad you joined us. This has been a good topic. It's a big time topic that people are having to deal with on a day-to-day basis. I hope you will include me in that conversation. And I hope you join me on the next Fun with Annuities podcast. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.